was.
During pandemic, there is Asian.
Let me
Remind
people really quick.
Okay. I don't watch the
So,
news, so like.
yeah.
Morning, everybody.
So
Thank you for attending today's Crypto Over Coffee. Today we have Mike Franco, right? Yeah, Franco. He's going to talk about just mining economics.
Yeah.
And just talk about that a little bit. I want to update some folks on upcoming event before Mike comes up. So we have our 1 year anniversary party, September 22nd, which is a Thursday. We have a really good line of speakers that will be speaking that day. So confirmation that we have Bitcoin Ben. We also have, of course, Pitsky Trippin. He's going to be talking that day about mining, and it's a week after the Muegge Rd, so it might be a good topic. Also, we're going to have the CEO of Ballet Wallet. His name is Bobby Lee. Bobby Lee. He's the brother of Charlie Lee. He'll be speaking. Miss King Crypto is also confirmed. She's speaking that day. She reached out to me over the weekend. We have some politicians too that will be speaking, local politicians that will be talking that day. Let me think. Natalie Brunell, she was a newscaster turned Bitcoin. I think she's a Bitcoin maxi, but you know she's great followers, a lot of followers, so she'll be here. Tone Bays will be here. He's always been very supportive of what we're doing. What do you think? Also,
Brian Estes.
Yeah, I can't forget Brian Estes. We have a lot of financial advisors that are interested in seeing him talk about just Bitcoin allocation in portfolio funds. So he's a very well-known individual. He's got a huge hedge fund that he manages. And as far as that, I can't think of any other. The CEO of Coin Metro is also going to be speaking, Kevin Marco. So he'll be speaking that day. And I think that's pretty much so far. I'm sure we'll add more folks to the speaking list. But as far as that, it's a free event for anybody that wants to attend. We're going to take up probably this location next door. They're going to let us use their space. We're going to rearrange some stuff here a little bit. We have our new Bitcoin ATM that we're bringing in. It's a bank grade ATM that does a whole lot of things. So the CEO of that company is coming in. Also, Doug Scribner. He's a good friend of mine. He's flying down from Miami for the night. Maybe two. He asked me to sleep in the pod here, and I said, but he'll be attending. So we have a lot of great names, a lot of folks coming in. Ballet Wallet is donating a bunch of Ballet Wallets for the attendees. So we'll be able to hand those out on that day.
When is it? I'm sorry.
The 22nd. It's a Thursday, so it's 2 weeks from this Thursday. So we're very excited about that. The next couple of weeks we focus on getting that in place. But yeah, reach out to us or email us. We would like folks to register so we know how much food to get for that event. But aside from that, I'm going to have Mike come up and talk a little bit about mining economics. Thanks, Jeff. You got it.
Cue the clap, the applause sound effect.
Hi, everybody. I'm Mike Franco. I've got a background in engineering and economics. And this talk really had its origins, a month or two ago?
Yeah.
When Jonas was talking about they see less business or less interest in the miners when the ratio, which is what all prices really are, the ratio of US dollars to, in this case, it was Ethereum, is lower versus higher. But as he was saying that the ratio of dollars to Ethereum now may not be the ratio at some point in the future. So what I'm going to talk about here is how people should really be calculating that both in their heads as well as down on paper or in a spreadsheet so they can really make more rational decisions, not just about whether or not to buy a miner, but anything in particular. So please feel free to interrupt me if you have any comments, questions. Also, if there's anything online, just remind me where I left off before I answer the question. Sometimes I forget. Just get carried away. So let's say somebody's going to spend, how much do we spend on a miner? What's the price of the small Ethereum miners now?
Oh, $1,400
$1,400?
for the 1,500. I think we dropped the price down on the 6 rig.
Yeah.
Yeah, I think it's like
Oh, man.
Did we?
price went down. 1,600.
Well, let's talk about that.
Yeah.
Let's
just
So,
say
I don't think
2,000.
that's
Say
right.
2,000. Okay. Man, well, if it's any lower than that, well, I might buy another one.
I
So-
also think we'll be something that will.
So, well, but that's part of that. What works out into that there is price risk over time.
Right.
So let's say I'm going to come here in the crypto world and say, hey, Jonas, Jeff, I want to buy a miner. I want to get involved in mining. And so what are we looking at? And they're like, well, it costs $2,000. You're going to mine some amount of Ethereum every month with a standard internet connection. And they say, well, that only yields whatever the current price of Ethereum in dollars is, which again is just a ratio, and it changes over time. So let's say I'm going to spend $2,000. So is this coming across on the camera?
Yeah, it is.
Yeah, I can see it from here.
Yeah,
Well,
we can see it on the camera
You
too.
can see it on the camera at least. Well, you can come up afterward at least, or at least I'm going to talk it. So you're going to spend $2,000. So that's a negative. That's an outflow. I'm spending money. So negative $2,000 in like right here, right now at the decision point. So then but I'm not mining dollars. I'm mining Ethereum. So it's not the price of dollars or rather the price of Ethereum in dollars today. It's the price of Ethereum in dollars at the time that I convert it back to dollars. Now, if I could buy the miner in Ethereum, then it's a lot simpler, right? I'm going to spend X number of Ethereum tokens or coins, and I'm going to acquire over time some other quantity. So at some point, you've got the amount I'm spending, right? So, dollars, or actually, we're talking Ethereum right now, right? So it's the little diamond-shaped Ethereum logo. Might have done it upside down, but whatever. And you've got time. So I've spent at some point in time, and then I'm going to start mining Ethereum, and at some point there's a crossover, right? Simple, right? Minus what I spend in electricity for mining the Ethereum, right? So like net benefit. So bring it back over here. I'm going to say I'm spending $2,000, not 2,000 Ethereums or 1 Ethereum or whatever it would be. But I'm going to get some fraction of Ethereum, let's say every month, or let's call it a year. So I had mine. I've got maybe $300 now. I've had it since sometime over the summer, probably maybe June or May. And so there's some fraction of Ethereum. Let's say, what's the current price of Ethereum in dollars?
$16.59.
$16.59 for 1 Ethereum. Okay. So let's say let's say, but at the time I convert my Ethereum to dollars, let's say that might be 2 years from now. What can I project, or what in the course of my own analysis, what do I think the price of Ethereum should be? You see, this can be very speculative, but you try to temper the speculation down with some analysis based on past behavior. So let's say the price of Ethereum, especially if we end up in some kind of hyperinflation, you're converting to something other than the inflated currency, which would be dollars in this case. So what does that come out to be? Let's say we're going to make $200 in, or, well, let's say $1,000 in Ethereum over the course of a year. Does that sound reasonable, or should we pick a smaller number?
You know,
Mine $1,000 worth.
You
Yeah, in
better-
terms of US dollars.
Yeah, you better get cracking on that.
Yeah, yeah.
because You got about a week.
Well, forget, yeah. So let's ignore the merge thing at the moment. That's really throwing. And by the way, I need to bring my miner in sometime in the next couple weeks to convert it to something else. But let's say we're going to make, I don't know. Let's just say I think whatever it is I mine, I'm going to be able to exchange for $500 at some point in the future. So, but then you take a discount rate, 1 plus whatever that happens to be. Now, say if I were to buy my miner with a credit card, which I did just wanted to try it out, that is basically going to be the credit card rate. Like, what's my cost of money? If I'm going to get money now, what am I spending just to have that? Basically, like time preference. So, let's call it, I don't know, 10% average between long-term compound annual growth rate and just inflation, as well as a credit card interest rate. So we're using the number, but then that is out. So this is 1 year in the future, right? So that to the first power is basically exactly what it says. But then let's say I'm going to mine an equivalent amount of cryptocurrency in year 2. So same rate, but now that's squared. So when you square your denominator, it's going to make this number smaller, right? This is now going to be something less than 500. And then you go out another, however many years you're looking at for your analysis, 3 to the third plus another 500 over 1 plus 10% to the fourth, etc. So at what point, what's my period? At what point in terms of discounted cash flow am I really making all my money back plus some amount that I'd like to have? It's not good enough if I just make my money back in terms of discounted future dollars. It's got to be something more than that. And so if I say, well, I need to have a 5-year payoff period at this price, maybe you've got it, maybe you don't. I don't have, I'm not going to go crunch the numbers out on my calculator here on camera, but we're maybe you make it back, maybe you don't. It may be that this would be, you'd want to pay maybe, I don't know, something smaller if you don't think you can make your money back plus a return, in which case you don't buy it. If you think it's going to be higher, if you think, well, maybe, I'm really bullish on whatever we're going to be mining after the Ethereum merge, I think this is really going to be $600 in terms of that currency at the time that I convert it back to dollars. Now, if we end up with a real bad hyperinflation, then maybe you never convert it back, and in which case we'd probably be pricing these as something other than dollars. Maybe buy it like for the price of, I don't know, like a 1/8 of the Bitcoin or something, and then you mine something in the meantime. And as long as these discounted numbers are become more than this outflow, then you're left with a positive answer. And the point is the answer positive enough to be worth your time? Now that also figures into what you should use as your discount rate. If you kind of sanity check it and you say, well, I'm positive here, but this still doesn't really sit well with me, kind of your gut check, maybe you're using too small of a number here to discount. In which case you're like, because this is your purchase. It's not like, well, Mike told me I should use 10%, so I'm going to use 10%. I just made that number up. Where maybe you're only concerned with the long-term, actually, we're not a compound annual growth rate. The compound annual loss rate in dollars due to fiat money printing, then this is going to be discounted less, so you're going to have higher. So this it's really important for people to know that the discount rate is unique to you and really should refer to your own cost of capital. If you're going to buy something, let's say you get really crafty, instead of just say putting on a credit card, you go out and get some investors together and say, hey, guys, what rate of return do you need for us to buy? Let's say we're going to go buy a Bitcoin mining farm, or rather invest in one. So what return do you need? So this is, again, this would be the cash flow, if you will, for the mining operation itself. So that operation has outflow to pay off the investors who have some expected rate of return. It also has any debt financing, which is usually a much easier number because the bank will just tell you what they'll lend you money at. And then you can figure out whether or not this balances. It also matters if you would be paying your equity investors a higher dollar amount is going to make, that's going to raise your discount rate. That's actually going to make it look like it's smaller. So your discounted cash flow here really then only affects how much money would be left in the operation itself after paying those equity stakeholders and all others as well. Any questions about this? Is this voodoo? People? No? All good?
Yeah.
Any questions online?
No.
Okay. Whoops. So if you are investing in, you're a hedge fund manager and you wanted to invest in a Bitcoin mining farm that Jeff was putting together here, then you're not just looking at this. This just is a way of looking at can the operation pay all of its stakeholders and then yield some internal return on top of it. But what's my return on equity in that, which is itself a very similar amount. Like I'm going to give Jeff some amount of money, and that my desired return on equity is something. So then is it at that point, is it positive or negative? Am I going to make what I want out of it or not over time? Now the real cash flows you get are going to vary. And then as we were discussing earlier when I took the stage, that there is a price risk, and that could go in your favor or not. Maybe the price of Bitcoin or Ethereum skyrockets. Like we were just throwing numbers around a couple of weeks ago. We said, well, in 10 years ago, maybe Bitcoin will be up to whatever we said, like $3 million.
Right.
So and we got just in our own napkin analysis, we came up with a rationale about why we think that would be. But that was, again, a couple guys do a napkin analysis. You could get more sophisticated and trim it in and say, yeah, but it's just an estimate.
So you really want to do an upper lower bound?
Yeah, yeah. So we think it could be up to here. And so, where for planning purposes, where do we think the point estimate is going to be between those upper and lower bounds? And maybe you say, you know what, I'm really conservative about it. And I only want to deal with the lower bound piece. Again, it's estimating is an aid to your own decision making. It's not just, there is no one right answer.
Mm-hmm.
It's unique to the person. Well, not so much the person doing the analysis, but the person who is the decision maker, which is probably going to be the same person in this case. Anything else? So if this was, $2 million, or I don't know, what do people invest in Bitcoin farms? Like when they're building the big ones?
Millions.
Millions, yeah.
5 to 10 million.
5 to 10 million.
Yeah.
Okay. So let's say if this was like $10 million, how much, but I'm spending $10 million, not 10 million Bitcoins. What's the price of Bitcoin going to be? Or what do I think the price of Bitcoin should be at the time that I convert it back to dollars? Which is really, so when do I think that's going to be? And it all comes down to what is the time period? Everything comes back down to time. How am I really not only getting a decent return on investment, but am I getting that return on investment in the time that I'd like? If the price of Bitcoin crashes, let's say Bitcoin gets banned worldwide and it crashes very lower, I would argue that it would actually be the opposite. It would become a black market asset and skyrocket. Like cocaine wouldn't be worth what it is today if that was a legal product, right? don't do drugs. That's not pick something expensive. I only pick on cocaine because it's in the movies as the expensive drug.
Right.
So, Wayne Hollywood. So they, if I thought that this would become a black market asset and I've got it and I could sell it, in the digital street for way more than it would be worth in a more legitimate market, then this might actually still work out even better. So, else you've got, if you're gonna price it in dollars, you just need a consistent unit. If we're gonna say, what's the price of Bitcoin and Ethereum? I want to trade my Ethereum for Bitcoin on my favorite trading app. Then you would use Ethereum, right? So what's the price of what's the price of what I'd be spending one Bitcoin in terms of Ethereum, but how much Ethereum is that Bitcoin going to yield me over time? Now, what makes this a little more difficult in that case is that there is no cash flow. It would just be whenever I trade it back from, in this case, from Bitcoin back to Ethereum, it would be at some future out year, right? You'd only have one payment. If I spent 2,000 Ethereums for one Bitcoin, then I think it's going to be worth, 10,000 Ethereums for Bitcoin. And then it would just be, 1 plus, whatever, in this case we were using 10% in, 10 years. Any other questions? But you wouldn't have any of the rest of this in the meantime because you're not yielding cash.
So can you apply this to historical data and get any trends?
Well, that would be what you should. Yeah, if you really want to try to figure out what your rate should be. Yeah. Well, so that brings up a good point. There's a difference between an average annual growth rate and a compound annual growth rate. In mathematical terms, that's the difference between the arithmetic return or the arithmetic growth rate and the geometric growth rate. One is linear and the other is nonlinear. So what people typically do is they say, well, the price was $10 and then it was $100 in 10 years. So then it was like it was 10% per year. Oh, that's my return. But is it really? Because what's really going on is this, right? So what would be a better way to model that? And so use a compound growth rate. You have this exponential function. And so if I was anybody, just download a compound annual growth rate calculator. You have a beginning point, an end point, and a period of time. There is a formula for it. I forget off the top of my head. Just type in compound annual growth rate in search engine, you'll find it. And that really that becomes your new best friend. So you're looking at, if you're going to then say, okay, in a spreadsheet, well, after year 1, year 2, year 3, year 4, you're discounting, but you want to see where the balance really is. Again, Jeff and I figured this out. We're just, a couple guys in the front of the store. Please do not say this is going to be the answer. But we were like, oh, okay, well, let's see. It's been
just for fun. Can we calculate that and how we figure that out?
Oh gosh, yeah, you're gonna have to remind me.
Yeah. I have the Kager app that we use.
Kager. We're throwing a raging Kager.
Kager app.
Yeah, it is pronounced Kager, like the college parties.
It's spelled different though.
Yeah, it's spelled totally different. So that's So we're gonna reproduce our back of the napkin analysis. So critique this all you want, please. So raging. This is gonna be Jeff's raging Kager. Oh, I didn't.
There's more markers over the left.
That's all. I'll take the red one here. So again, compound annual growth rate. So we said the price of Bitcoin today in dollars is what?
Right now it's exactly At 20,000.
20,000
Yeah.
for,
This one might show up.
does this look, that one? Here, what? Oh, that looks much better. Thank you. Okay, so. Put the caps back on the markers without coloring with my own fingers. Okay, at T0 today is, so the Bitcoin at T0 is 20,000, and we're going to apply a growth rate. We take the earliest Bitcoin price you can find in let's say in the last 10 years.
Was it 2012?
Yeah.
2012.
Pizza day, right?
It's 20, was $13.50.
Okay, so it was at BT minus 10 years ago was, sorry,
$13.50.
1350. So somehow we got from 1350 to 20,000, right? And that was in 10 years. So go on the app there and do
Initial investment or starting
yeah,
value,
your starting value is 1350.
and
Your ending value is 20,000.
years.
You're going to get it's going to look enormous
Is it number
because
of-
it has been enormous.
Number of periods is 10, or
Yeah.
or is it
Yeah, just like that.
okay?
What does it tell you?
Compound can't be 10. I think it's 10 months is what.
No, that's right.
Okay.
20,000. Yeah. So let's get back. What did it say your rate was? 107.52 was the CAGR equals 107.52%, right? So if you were to just in a spreadsheet type in this number and add 1 plus 107.52%, and then take the prior value, and so you just increase it by that amount every year, you're compounding on itself, you would end up with this number. That's all calculated. Sure, it would be more detailed if we had it out to pennies or hundreds of cents or whatever. Again, simple analysis. And then let's say we temper that, we take another range. Let's say we think Bitcoin has really stabilized in terms of dollars over the last 5 years. But pick a time. What is there a more conservative period? Because remember, this number is only based on 3 numbers: the ending value, the starting value, and the period of time. If you pick a different range of time, you're going to get a different answer. Like this is going to be a different number. So is there like a more conservative range?
Like 2016.
Sure. Say 5 years, 6 years. Let's do 5 years. What's 2017?
$434.46. $434.
Okay, so let's take Bitcoin at T is -5. So over the last 5 years, it was. Sorry, say that again.
434.
434. And what is that? What does that get us?
Cager?
Yeah.
That is 115.13.
Oh, really? It's even higher.
Yeah.
So 20,000 at 5 years. What was the
115.
115%?
Yeah.
So if you had put $434 in Bitcoin in 2017, you'd end up, it would have grown at this rate each year to get up to 20,000 now. So
What might be good is to
Yeah.
actually go back in
time a couple years and put that as the end date, just because of the artificial money supply? Like,
Yeah, so the point is you're gonna pick,
Again,
again,
see how it's slowing down also.
you're based on your own judgment, because again, we're getting really large rates here. And again, because Bitcoin has skyrocketed in that period of time. So you're trying to think how many of those is appropriate, and that's still like up to the mind of the estimator to say how many, where are we really looking at as being what we think is a good one? Because we're gonna extrapolate this rate out for another 10 years.
So you want to look at yearly CAGR from
That is,
From-
you take maybe an
1 year
average
to the
of
next.
10 years, and then these
every
rolling 10-year
year
periods. Yeah.
period and see
Well,
what this.
well, you wouldn't do it if
what-
you're only doing it every 1 year, then it's going to be just that one number.
Well, you want to do it every 1 year interval since the
Yeah,
beginning,
yeah.
and then you can see
like a
maybe how
rolling-
it's increasing
A
or
rolling
decreasing.
3-year, a rolling 5-year.
Yeah.
Well, 2015, it was $313, so the CAGR was 81%.
Okay. So if we get, so there was another value here of 81%.
2015.
Sorry, you have a question. Other people keep interrupting you.
What's the formula that you're using to come up with these percentages?
Oh, what is it? CAGR
The
form.
standard.
Yeah, it's CAGR
Whatever it is.
formula. It is. Oh, it's good to bring up here. So
Formula?
yeah.
Here it is.
Oh, perfect. So if you wanted to do this by hand, so the formula, you'll put it up in this corner. Is it still visible?
Yeah.
It's your final value, your ending value here, divided by your beginning value. You know, again, which period are you looking at? Oh, to the 1/t power, meaning in the number of years or periods, if you were doing like by decades or months or whatever. But then you're not using a compound annual growth rate, it would be a decadal growth rate or a monthly growth rate. So don't, be very careful. Oh. No, it's all of that minus 1. There you go. I got it there. So that's the formula itself. You wanted to crank it out by hand.
So how did we get to 3 million on our last?
We took one of these rates. We took let's average 81 and 107. So what's that?
81 plus 107.
Yeah, divided by 2.
94.
94. So we're saying, look, we're going to project out for the purposes of this analysis and this analysis alone, a new growth rate going forward of, you say 94, of 94%. So then what we do is we take this value, similar to the formula we used before, except instead of that 1 plus the rate over a period of time being in the denominator, now it's in the numerator. We're increasing that value. We're looking at future value of a current investment rather than a future return of or rather a discounted future return. It's future value of a current payment versus current value of a future payment. So we end up with, we have our 20,000 here. 20,000 times 1 plus 94%, so it's 0.94 when we're going out 10 years.
Mm-hmm.
So it's that. 1.94 to the 10th power times 20,000.
How do we calculate it? Let me see. Any calculator? Or what?
Okay, so let's take, there we go. 1.94 to the 10th power is 755 and change times the current price of 20000 gets us to 15 million and change. So again, we've been looking at these huge growth rates over the last 10 years, right? And we're saying, well, if we were to try to eyeball where we think that growth rate is going, and then we extrapolate it out that far, then where would the current value be in that period of time? Super speculative. Again, I'm not saying that the price of Bitcoin is really going to be $15 million in 2032, or am I? Then, but that's the type of analysis. You change the starting value, the ending value, you change the period, you're going to end up with different numbers. So the point is to just say, you're just trying to get a swag and say, I think it's going to be somewhere in this range over time. Any questions?
Here's the actual pager for Bitcoin the last 10 years.
Oh, good.
So that's,
Yeah, if you put that in the link for the show there, and people can play with it. All right, so that's the end of my talk, the number of topics I wanted to bring up here.
So you said
Stuff makes
Bitcoin will
sense.
be 15 million in 10
Exactly.
years? Okay.
15,102,000 and whatever the rest
Yeah,
of
you
the
heard
calculator
it from Mike.
That's right.
What
I said
year is
30.
it?
10 years from now.
In 2032.
All of a sudden, my 1/10 of a Bitcoin I own. What's not that?
Yeah. But the point is to remember that you spent dollars to get the Bitcoin. It's like, again, what I started with when I took the stage here was that all prices are just ratios. Nothing more, nothing less. How many crypto world t-shirts like this one are worth 1 Bitcoin? I don't know, probably a lot. But that number would change every day or from moment to moment, right? So what's the price of Bitcoin or Ethereum or whatever in these collectible t-shirts you can pick up out front, or probably on the website? I don't know.
So if inflation keeps going at this rate, by the time 1 Bitcoin is 15 million, maybe
Yeah.
1 loaf of bread will be.
That's right.
15,000.
That's correct. Yeah. Yeah. We're pricing Bitcoin in dollars here, which the price of everything could be up higher. So that's a nominal price. In terms of real purchasing power, you'd be looking at, I think you'd use the CP, the consumer price index, as your growth rate, and say, okay, how much does that change over time? You say, well, the price of bread today, you do the exact same analysis. The price of bread today is whatever it is, $2.
You fill up your car with gas for half Bitcoin.
Yeah. So what does that come out to be in 10 years? I know over the course of my lifetime, prices are about 1.5. It takes about 20 years for prices to double, give or take a few years. So historically, yeah. In the last 50 years since we went off the gold standard. So that's because then at that point now you divide one into the other. Now you have the price of Bitcoin in bread, right? You're eliminating the otherwise the common unit of dollars at any point in time.
How does anyone even want to consider investing after all this?
Well, if you end up, if it comes down to, what do you mean, if people actually wanted to apply this analysis to invest with, I think they should. Whether or not they want to invest in general comes down to, are you going to exchange your dollars for something else? So you may end up with the whole like Weimar Republic thing where the employees get paid like every half day because the company wants to get rid of their German Reichmarks as soon as possible, but the employees want to get rid of them as soon as possible too. So they have their housewives lined up outside the gate with wheelbarrows to go dump the cash in, and so they set up this bizarre market outside, but then like the next layer out. So they're all trading their marks for other items as soon as possible, just as a hedge
Before they
to the
become
before
worthless.
before they become even more worth. Like, there's a reason why the company's paying the employees twice a day instead of once every other week or once a month, right? Because they're trying to get rid of the money as soon as possible too, and then eventually it gets so bad that some hoodlum robs one of the housewives, dumps the marks out of the wheelbarrow, and runs off with the wheelbarrow. That's true. So the part of the value of Bitcoin in this analysis could be as just a hedge, an inflation hedge, pure inflation hedge. That I'm just exchanging my dollars for anything else. Yeah.
So I took the average Kaiser for the last 10
Yeah.
years. It's 47.9.
Okay.
Can you
Let's
calculate?
do that.
Let's
Thank you.
calculate that.
That's a better. So we had. We're still going 10 years out.
Yeah.
Okay. 47.9. So now let's take 1 plus that, so 1.479 to the 10th power is 50 and change times 20000. That gets us to a little over $1 million. So I'm more comfortable with that than saying
Yeah.
it's 15
Yeah.
times that number.
Yeah.
So, but anyway, okay. So we added a little more fidelity to our analysis, and we said that the price of Bitcoin in dollars is going to be $1 million and change. Is it? I don't know.
That's what they said.
Well, it could be. Yeah, in 2032, the price of Bitcoin could be $1 million, just based on our own analysis. Again, somebody picks different numbers, inputs, they're going to get a different output. Yeah.
Can I ask you a
No, you can't.
question?
Sorry, go ahead.
Out of this subject.
Yeah.
Are you close relative with Victor Franco? Your name is Franco, right?
Franco. Victor Frank from that survived the Holocaust and wrote.
Yeah, meaning of
He
a
was
life.
Frankl.
Oh, okay. There
It
we
was a
go.
different. It's a different last name, but
Okay.
I don't know, maybe, but
How about Generalissimo Francisco Franco?
no, not related to him. But
He's the one that wrote the logotherapy,
yeah, he was good. I got his book.
What are your thoughts on if you're gonna be doing something like this, turning it into a business, even at a small scale? Because then you can deduct your losses, you can deduct your
Yeah.
expenses, you can
Yeah.
also transfer it over to capital gains, get
Yeah.
taxed differently whenever you convert it,
Yeah,
the whole
and
thing.
you can do well, anybody can do tax loss harvesting, but you can it's the earned interest, carried interest. If you were to basically set up your own hedge fund, basically almost like just the same. It's the same analysis. Short answer, yes. Next question.
This model assumes exponential growth,
Yeah,
but most projections that I've seen for price are logarithmic because they assume that a lot of the growth that it's seen in terms of going from $20
Uh-huh.
to or going from a $1 market cap to a $1 trillion market cap. Like you
Yeah.
can't have that same sort of exponential growth.
forever. Eventually,
Yeah,
it'll
because
level out.
We'd be if we saw the same sort of growth that we saw in the last 10 years or the next 10 years, it would be like
Be $1 million,
Giga-
$1 million. Yeah.
something, it'd be a Googleplex,
Yeah.
right?
So at what point does it level off? I don't know. But that's the price of one thing in terms of the price of something else. So what is that other thing?
Right,
In this case, it was dollars.
but it could be gold or oil.
Could be, yeah. Yeah, if you could spend a barrel of oil for one Bitcoin, whatever, then, and vice versa.
Yeah, it is fun to play with the numbers like that though. And, you know, the thing is, like you're saying, if Bitcoin's $1 trillion now, to go from 20 to 100 is 50 times.
Yeah.
Is it possible to be a $50 trillion asset? You know, and that kind of shows us why we're here.
Yeah.
If we get probably more than a 10% return, we're doing good. And we got a spread, you know, you want to have maybe a house or a condo or whatever you got and diversify.
Yeah.
That's the key, because we don't know if it is a true inflation hedge. You know,
Yeah.
last year it's gone
It's a
down,
very-
inflation's been 10%, so it
Yeah.
hasn't been.
Yeah.
But if we can get a 10% or 15% return on it, it's going to be huge, you know.
Yeah, for a 47.9% return.
If you could get that,
Per year,
that's,
yeah.
that's, you know, 1 in a million, but we don't have to get that to get to where we want to be. If
Not
you know what I mean.
necessarily,
If-
yeah.
If
So
we got a 20% return,
being very, let's say, not having a whole lot of faith in our analysis we've done here, which has gotten better while we've been doing it. Thanks, Jeff, for averaging the Kagers for me. So at what point of your overall life portfolio are you really optimizing your own life value, or economists call it utility, which is a really abstract concept they like to think is firmer than it really is. That if it were me, I mean, I could go have a whole other thing about like how I would design my own portfolio across, you know, businesses, reserve assets, and real estate, and say, how does this really fit into that framework? And I'm only looking at
well,
like
that's a great conversation.
1/30th.
Right, 'cause we all have a fixed amount, you know, the cost there, the cost of money, like you said, the
Yeah.
opportunity cost, and so the cost of the capital and how much capital and in time. We all are limited in
Yep.
those things, and
Right.
now we want to, you know,
Mhm.
set them.
And that's why everybody gets different numbers.
Analysis you got.
And they
there,
have
right?
exchanges, so
Right.
people buy and sell based on, you know, they're all trying to optimize their own present value and near-term value by thinking, okay, how much good is this going to get me by planning out 5 years, 10 years, 20, whatever. People may not realize this, but the long-term compound annual growth rate of the S&P 500 is only like 7.9% plus dividends. So if you're really going to, it's smaller. Well, yeah, but I mean, we're also looking at, you're looking at like the growth of the long-term growth of the 500 largest companies, and the 500 largest companies change over time themselves. One drops out and another substitutes in. So, but if you were just going to say S&P, here the CAGR of S&P 500 is only like 7.94, I think. It's less than 8%. So if you're not making at least 8% over a long period of time, you might as well just buy a ETF, right? The exchange traded fund. Most popular one's SPY. There's also VLO, which is Vanguard's equivalent.
ETF is very hard to sell than an individual stock.
I'd argue the opposite. The exchange traded fund is
Easier to
yeah,
sell?
yeah. It's an exchange. It's traded on an exchange.
It's very liquid.
Yeah. So you can sell. You could buy the exchange traded fund, buy the entire S&P in one trade, and again, expect, not guarantee, you expect that number to grow by this amount every year for umpteen years. Like people do that with their retirement accounts. They say, I don't care what happens in the next 20 years. Like, I'm 40, I'm going to retire at 60 at the earliest. And so whatever I put in now is going to grow. Again, I expect it to grow at that rate. Yeah. That they all average out and you're left with this number. Okay. That's a longer time preference.
Unless it's a policy change.
Yeah, unless, well, politicians find ways to fund their boondoggles at the expense of everyone else's hopes, dreams, and desires. Yeah, so that's part of the hedge, right? I mean, really, let's say like the real appeal of Bitcoin and cryptocurrencies in general is a macroeconomic hedge. You'd say, I don't need to deal with you at all. I can trade peer-to-peer and bypass that entire geo-financial apparatus in governments and banking, et cetera, that have provided a service, but they all take a piece for providing that service, right? They all find a way to get paid, but if you can bypass them all and say, well, I can deal with Jeff directly without, in a public ledger, without having all of these intermediaries, well, that's a more efficient trade.
That's right.
In general, it is,
That's right.
but that gets into this would end up being a very different conversation of how do competing interests play out in a overall like societal framework, and how do those societal frameworks compete with each other in geopolitics, and if you can frame that in terms of their growth, because again, they all have those logarithmic growth rates like you were talking about, right? Are we done with this?
Yeah.
Okay. So let's say this is off topic. We're done with mining economics. So I've got my society, and I'm in charge, and I'm propped up by people who think I'm doing a good job. So our growth rate is, like that, right? It's a S-shaped growth curve. I think, kind of like we were talking earlier about how societies conflict and how conflict breeds within societies because of improvements in communication technology and exposing interfaces that are uncontrolled and in fact didn't even exist previously. I think conflict happens like here as that growth rate bends over, because everyone's like, well, I'm used to my share of society's wealth, or the value of my wealth. I want to increase like 5% every year, and now you're telling me it's only going to be 1.5. Well, I don't want that. I'm gonna keep pursuing my growth rate, but you can't really understand in advance where that point's going to be. It's just observed after the fact as they start edging each other out, the major players, because this person is really, this is there's also, let's make this look like a word chart or a tree diagram. You've got, because not that anybody is really an autocrat, but I like poking at this as an archetypical example that every autocrat's only ever as good as the aristocrats that prop him up, right? Because they all have, hey, they all have growth rates too, and say, if I'm here, this guy's he's happy, he's still growing up a lot, and maybe somebody's over here, maybe he's dipping a little bit. This guy's mad. Hey, boss, you're not doing good for me. And if you can't, I'll find somebody who will. And that's why you see a lot of looking at classical history, especially the Greeks and the Romans, and even up through the medieval period, and probably even today, but the examples are less obvious because you don't have several hundred years to distill the lessons out, is that if I'm losing money year over year, or wealth or prestige, whatever, that I'm upset and I'm going to try to get it, I might end up edging out this guy here. Well, that guy doesn't like that. And so what they'll do is they'll promote one of themselves in their aristocratic class to serve as the autocrat to promote all of their interests. And if that person can't perform, then they off him and they put in somebody who they think can. Right? Why is Queen Elizabeth so old? It's because she doesn't wield any real power. If she did, she wouldn't have lasted this long, being the kind of tongue-in-cheek remark. So what happens also is they like, hey, we're leveling out here. This isn't fun. I want more. So this guy goes and invades a neighboring country or some other fiefdom and says, hey, we need to grow. The aristocrats are coming after me now with daggers out. Like I've got to perform. So that's eventually I'll do something with this kind of analysis and say that just this explain conflict and history is there. There's some, what's the impact of this kind of like geopolitical thing in regard, is it motivated really by these internal dynamics?
Yeah, it's really motivated by the moneylenders.
Well, yeah, anybody, man, anybody who's saying, hey, boss, you're not performing, get with it.
Yeah, we see this in corporations, right?
Oh, yeah.
Like it's
Yeah, the board of
What's-
directors is like, look, hey, we're leveling out here. I want my return.
Yeah.
And some of that's healthy.
so let's acquire another
We'll
company.
buy another one, or
Yeah.
we're going to invest in a new product line. So that can be a good thing. Like I'm trying to be. I use these very violent, late antiquity as a metaphor, but it doesn't really have to be in that form. I just think it makes for a better story. It's more fun to tell, at least. Then, but they could say, hey, we need to do more. I got to perform. I've got these stakeholders that are propping me up, right? Like the board of directors. And so if you're not performing, it doesn't mean to kill you. They just fire you and put in somebody else.
This question.
Or they liquidate the operation entirely and just go off and do their own thing. Sorry.
This question is out of this line of conversation.
Mhm.
What are you thinking about that? What is his name? Facebook used to.
Zuckerberg?
Yeah, he's projecting in the future that we no longer watch TV. Is this a whole bunch of new era that
Metaverse.
we are gonna live? Do you heard it, and do you have any
I've
thoughts about
heard a
it?
little bit about that. I think
It scares me somewhat.
I think it's massively overplayed. It reminds me of, I can't even remember what it's called. But I think it was a Bruce Willis movie in the 90s. There was like everybody just interacts with each other as these animated mannequins.
Yeah,
and they
something like
remember,
that, yeah.
and they never really see each other. Everybody's presenting this optimized version of themselves, this perfect versions, but they were doing it via these kind of like Android avatars out there that were all controlled by. It's basically like if The Sims was real, almost like that. So you never see each other. You only see what each of you wants the other person to see.
Huh.
And there's a fair amount of that. Everybody wants to look their best and present their best selves or what they perceive their best selves to be, and they're not. There's a lack of authenticity in all of it, and I think that Zuckerberg's metaverse is just the next step of that. Now there are some positive aspects. They say like, oh, they're having a wedding in the metaverse, and it just seems like laughable at first. But they're like, well, if you don't have to travel, you can see everybody and interact with everybody there without having to travel. Okay, I can see some like that appeal. Like there's a little bit of goodness there, but it doesn't mean you're all really together, like people want to believe they are. Kind of like I've been just within this audience, I've been very skeptical of NFTs, but I've seen some areas where NFTs can really lead to real market. Like if I was a Nike and I wanted to release a new shoe, but I wanted to conduct a safe to fail experiment, I can release it first as a series of NFTs, and there's a market. People buy the token, the non-fungible token, as a picture of this new shoe, this new design. Then I can see what's the relative value of all of them to each other and say, okay, I can go release this one in the real marketplace, and I know there's a market for it. Oh, and by the way, if you already bought the NFT of it, you can get a coupon or discount on it, which that helps drive people to act, right?
Interesting
And
idea.
then they're actually using the NFT as a marketing tool that they can actually, in effect, exchange it then for real cash for their physical
future.
product.
Right.
Good.
And so there's that like that. I totally get that. If somebody's just going to buy a piece of artwork to put on their computer screen, I don't see the point of that. And if you can turn any of those things into cash assets somehow, some way, I take it all back.
Yeah, I'd love to make the argument for NFTs.
Yep, sure. Well, Dave, looks like they need a speaker on the 20th. Go talk NFTs. All right. So
it was 27.
Yeah.
Oh, that, they're.
that says
they're just
coffee.
open up.
Oh,
Yeah.
well, I don't know what.
Well, I think because the year anniversary is the
Yeah,
same
they're
week,
just-
so
Oh, okay.
take-
Okay.
yeah.
So yeah, talk to Jeff and Jonas about being the speaker on the 27th, talking about NFTs. And again, if you can find a way to really make a value thing, I find then I'll take my entire criticism back.
All right, we're at time.
Yep.
So closing remarks.
Oh gosh, I've given my closing remarks. I'll make a point now to wrap up with this, that don't be afraid to do some math, and you'll find it in your interest to do so. At least if it doesn't turn out the way you thought it would, it may not have turned out the way you thought it would yet. And if anything else, it just gives you an opportunity to improve.
All right, thanks.
Over.